Hey guys, my name's Max. I appreciate you all for tuning into my channel. Have a great video planned for you today. Name of the video is Option Bro Makes a Crazy Market Call. Cem Karsan is a force of nature in the option world. Jim, it's pronounced, it sounds like Jim kind of, but Jim was a market maker in the S&P 500 pit. At one point in 2012, according to him, he and his partners, their market making business did something like 12 or 15% of all the business in the S&P 500 pit. Well, anyway, he got out of that business and he got into wealth management, and specifically he's into option focused type volatility strategies. The name of his company is called Kai Volatility. So he has a large presence on social media, and that's how I found him back in 2019, maybe 2020. And he taught me and a lot of other option traders, a lot of other retail guys on Twitter. He gave us, a lot of inside baseball. His big thing in life is studying the order flow of the market, specifically the dealer positioning. So he can tell by how the dealers are positioned if the market's more likely to have a crash or to have or whatever. A lot of what the market does, according to his theory, the market is, a lot of it is a feedback loop and is reflexive. You've heard the old saying about the tail that wags the dog. Well, in an interview about 6 months ago, Jim said options are the dog. Anyway, this guy's my kind of dude. He's an option bro through and through, and he's specifically a volatility dude. Follow him on X at Cem Karsan. When I started following Jim, he was explaining the concept at the time, this was like 5 years ago, of fixed strike volatility, sticky strikes, and how an index would become penned and pen a strike, stuff that's not in any books that I've seen, and it just knowledge that I was not able to get anywhere else. He's always a good follow on Twitter, even to this day. There's a ton of technical nuances to get familiar with if you really want to get into trading options. I've been covering more and more option-centric subjects, but nonetheless, this is a general market call, and he's made some pretty accurate market calls. So, and this one's a doozy. Anyway, I'm going to watch it with you guys. I may get up, but I'm going to listen to it. And then I'm going to come back on as soon as it's over with, and we'll talk about it for a minute, okay? All right.
Election right at the time when Mr. Cem Karsan, a regular here on the Schwab Network, suggested they might. He's a senior managing partner, Kai Volatility Advisors. How you doing, Jim? Good to see you.
Good to be back. Good to see you.
I feel like you're probably riding pretty high right now because we got a few things you were looking for. The yield got close to 5. We got the 10-year to 4.8, which was one of your predictions from last year. And then you had a pretty nicely timed tweet that basically said the election gap would close essentially the day it did. Which of those matters more here? How do they fit together?
Oh, well, the gap close was that was going to happen eventually here in January 13th. We got it right to the day. That felt good. But the bigger deal is yields. Yeah. Bigger question is where are they going next? And, just like we called for 5 when we're sitting at 3, we're calling for 6.25, 6.5 here now this year. That's going to be a very interesting move. I think it'll happen gradually. I don't think it's about to take off there. We could digest, pull back a little bit even before that. But I do think we hit that, in Q3 probably, not even by the end of the year. And I think that starts a bigger decline that I do see coming out on the horizon. That's at least one of 2 paths that are really sticking out to me at this point.
Can you help me understand in a brief diversion, because we got other stuff we're going to hit too, but maybe what Waller's thinking when he sees 4 cuts this year? I mean, didn't we just realize in the last 3 months that cutting when GDP is 3% kind of makes the bond market do wild things?
Yeah, I think the Fed is pretty much understands that the market is everything. And it's not about whether they're going to cut or not. It's about the narrative and supporting markets through this period. Especially coming into the spring, it's well understood if they can keep a cap on interest rates early. This is why, like last December, they were also surprised. Everybody was surprised at how much they were really trying to put out that they were lowering rates. The structural effects in the economy are very tied to that spring. So if they can do that early, that's really good for the market and the economy. But they have to get out in front of it. And if they don't, weakness begets weakness. And they really don't want to see a weak move into March here, which I think is very possible if they're not accommodative right here. They don't want to see that 10-year yield creep higher from here. Weakness, and remember, it's a $100 trillion equity market. If you got a 10%, 20% pullback, that really starts to affect the economy. The market leads the economy, and that liquidity will then need to be countered, and it'll probably be too late at that point.
Okay.
So I think they're really trying to be proactive, particularly at the end of the year they were doing it. They're trying to show they get any chance they have that they can do that, they are going to do that.
Do you think that over the last 3 months, that move from September into the 4.8 for the 10-year, was that because they were cutting? Because then we get into a tricky spot where if they try and help the market by talking too dovish, then
actually spot on.
Rates will keep going up, right? If you think that was the causality.
We talked about that here. I mean, you may remember 6 months ago.
And I'm convinced it was the causality.
Yeah, when we talked about why will this go to 5, you're like, whoa, 5, how, really? That's a big call. Remember, the reason was because they're going to be aggressive in cutting, which is structurally inflationary. And to be clear, if they are accommodative here, the market will hang in, and we won't have that decline yet. And instead, we'll get a blow off top.
Okay.
They are trying to keep the plate spinning, but these yields cannot keep going where they are going, and this be sustainable. It's not. Yields can't go to 7, 7.5, which they will go to be clear, if they are as accommodating as they said they would.
Okay, so what they really should be doing is talking what? Like tamping things down?
I mean, it's a dangerous act at this point. Valuations are really high, right? Liquidity, there's some liquidity issues coming on the table. We have a new administration, all kinds of potential risks, right? But imagine now that they don't do anything and they're behind the curve. So they're trying to do the lesser of two evils, I think, and project that they're cutting, but that's ultimately going to drive yields higher. It will probably drive the market higher if they're really aggressive and then really get a blow-off event, which will be worse. They're actually provoking volatility, not compressing it, in my opinion, but it's a balancing act. And I really feel like if they don't do it now, we're going to get a decline sooner. And I do think it'll be a big one, 30 to 40%, if they don't start cutting and projecting monetary policy here early.
This sounds like a bit of a more kind of a macro-driven, kind of volcanic type of event that you're describing than I think a lot of our conversations, which are these kind of periodic moments of weakness, windows of opportunity for weakness. It sounds like you really think that the pot might be boiling over in a way here this year. Is that fair?
It's a function of timelines, right? When we talk flows and macro, we're generally talking weeks, months, maybe a quarter if it's a big end of the year thing like we talked about. When we start talking about years, that's when the big picture stuff matters, right? And so, yes, it is a bigger picture. We talked in detail about the election years and how over all the populist elections were an average of 21% up. Right? And that all of them were positive double digits. And if you pulled out those election years, the election years were 5%. That 68 to 82 period, 14 years, went nowhere. If you pull those out, negative 10 per year in real terms, over 70% loss. Those are big macro picture things. That's a function of liquidity during populist election cycles and what happens afterwards. Guess what? We're no longer in an election year. 68, 69, very similar type of setup. Go take a look. You get a very, very positive election year. New president and Nixon, who in a lot of ways mimics Trump in a bigger picture way. And for the first 6 months, things were okay, kind of chopped around. Remember, tops are processes. Bottoms are events.
Okay.
So this, I believe, unless the Fed gets involved early and changes the trajectory of this, is a topping process we're amidst.
And they would have to do that by sounding more hawkish.
No, actually, they would. If they are dovish now, they will extend the story. They will get more of a blow off top.
Right.
And then the decline will come.
Right.
It'll just come with higher yields a bit later. So 6 months, a year later. We're not talking about years later, right? So this is a function of path, right? We know the destination in terms of macro. Okay? The question is, what are they going to do with liquidity to change that path?
Okay.
And if they're trying to keep the plate spinning, which they're prone to do, new administration probably pressuring the Fed as well,
yeah.
right? If they go that path, then you likely won't get the decline yet,
right?
Because those flows act in the short term to
but
support.
You're building the tender for a big fire.
Squeezing the shorts, you push the thing up. It's a volatile market up, not for a day or a week, for months. Think 98, 99, right? These are big rally years that ultimately are undone,
yeah.
Right? But the path is different because of liquidity. Greenspan changed the game there and led to a bubble. It wasn't the irrational exuberance; it was the liquidity. Right? And so if they decide to pump liquidity, we will get a blow off top.
Sure.
And it will be volatile and it will be long vol, right? That will not end well, and it will not be years, by the way. It will be maybe another year. But the picture from a macro perspective is not good, and the market leads the economy. So if we start to get a decline, we will also have a recession in Q3, Q4, which does not look like it now, but it will come on the back of a market decline. And so the question is, what is the Fed going to do? Are they going to be actually accommodative, dovish early, and try and keep the plate spinning and force a real liquidity push into a short, a market that will they'll be able to squeeze the shorts into high valuations? Or are they going to wait, see what happens, and then be too late?
Okay.
And then catch a declining market into stair steps, which again I think will be 30.
But would that be
40%? I'm talking like a 30 to 40% decline by next year if they don't do that.
Okay, so if they don't, to be clear on that point, because the question about whether or not they could stop setting the tender for the explosive fire by being more hawkish relates to that point, which is, are you saying that either way there's going to be that type of event basically at mid-year? Because it sounds like, one, if they're too dovish, they're setting the tender for the burn.
The timing changes.
The timing changes, okay.
That's exactly.
If they're more patient or hawkish, if you will.
To be clear, if they are dovish, we get a bigger, faster move up.
Right.
And it probably doesn't end until September or January of next year.
Okay.
Okay. If they are not, if they are, let's wait and see, in front of inflation, right? I think we get a decline and force their hand. But I think amidst that decline, it'll be too late.
Okay.
Because
for what,
the amount
economy?
of liquidity, again, you have to understand, people miss this, that when you remove 20% or 15% from a $100 trillion market, you remove 15 to $20 trillion of liquidity from the market collateral.
We've also got households more tied to stocks than ever.
That's conservative, right? And so you have to understand there's a momentum aspect to this. And so if a decline takes hold in this environment, it will be too late. They will not be able to do enough, okay? And amidst that, I think, and again, I don't see that happening in the next month or two. We're talking, if that were to happen, it would probably be closer to June or Q3.
Okay.
But again, I think that decline is the more likely scenario because I don't think they're going to be as dovish. But maybe new administration. You hearing something from Waller, like you said, it's possible. And Trump is a Nixon-like figure. Arthur Burns, their echoes there, right? I wouldn't be surprised. We've been talking about this for some time. If ultimately he does put some pressure to run a little bit hotter.
It seems like that's the plan.
Yeah, and if that is the plan, so kind of let's see what happens. That's important. I mean, there's a big picture, macro picture, but that liquidity matters over the course of the next 6 months to a year. And there really are. I want to be clear. People are going to say, "Well, you're calling up or down. Thanks a lot." The reality is there's 1,000 paths. I'm giving you two.
Right.
I'm giving you two paths and time and speed and direction. And a big move up would end up at 6,600. Okay? That's the type of move you get in a year. And if not, we're going 30 to 40% down. This is not a sideways market. This is a volatile market coming. Prepare for it accordingly. Long-dated calls, I've talked about this before, are way too cheap. We're talking about a 10.5 vol.
Okay.
It's insane. You should be, we've said this before, they've been very lucrative by doing this. Own those, be short stock against it, because if the rally comes, you're getting volatility upside, you're getting leverage to the upside. Those will perform into a rally, and if we decline, you're short stock, and those things are cheap.
Okay. Do we put on the bond shorts now? Is that the stock trade, the two paths that you gave for the stock trade sound like things we have to watch and set up for? Own the calls sell the stock, but in terms of the timing for those two paths, those are mostly like second half events more likely. For bonds, if we're going to get to 6, should we be taking this opportunity to sell bonds already?
No, wait for a pullback. I would say, again, watch monetary policy and what they're saying. If they are running it hot, then yes, you want to short them as soon as possible.
Exactly.
If they're not, you really want to wait for a pullback, right? Before you get that. But again, I'm talking about for the pullback in the market, which would drive.
We're talking bonds or stocks? We're talking stocks.
Pullback in the market, yields would need to come down when that happens, and that pullback in the market is not likely coming till later. So.
Okay.
Two paths for bonds. Let me be clear again. I think the first one involves a small pullback here into the next month or two, followed by a continued run in yields to closer to 6.25, which would then provoke the decline.
Okay.
Okay. The second path is really accommodative monetary policy, crazy steepener, and you see things run quicker and further, faster.
Well, the dovishness equating to building the tender for higher yield sounds like every time somebody like Waller comes on, I might as well start loading the boat if it's going to get there eventually, if I date my expiries out far enough.
Agreed, but again, the more obvious it seems, the more likely you are to get some decay on that.
Sure, fair enough.
And for how, you'll get that pullback. Again, when we called for yields to go to 5, they were 3.5.
Yeah.
They ran to 4.5, and we were like, look, and then they pulled back to 3.6, and then they ran to 5. So it's never a straight line. Just be ready for that.
Love it. Good stuff. Appreciate it, Cem Karsan. Fun to check out the possible paths for bonds and stocks going into this year.
I think he's a sharp dude. There's a lot more information on the internet and a lot better interviews than that one. I'll probably have some more content soon. Cem Karsan's really sharp, dude. I really like him a lot. I appreciate you guys listening to that with me. He's been making the rounds lately. He's said this on 2 or 3 shows the past couple of days, so you guys may have heard it. He was on another show, and he went more in depth with some of the option centric stuff. So I'm going to have more content on that later this weekend. But this was just basically the Reader's Digest version of what he thinks is going on. Now, he's made some tremendous calls in the past. The other day he called on Twitter, he called which day the gap would be closed. He follows that same gap that we follow. Every morning that I was showing you guys that election gap, well, not just him, but a lot of people did. That was a big deal. But in any event, he also called the recent rise in rates, but he wasn't the only one. Other people have as well. But he's not always right. I would say he's right about half the time. So, but it's interesting. It's interesting. I think it'll be interesting to see what happens. I want to know what you guys think, though. What do you guys think about the call? Do you think it was warranted, or just for clicks? He doesn't know what he's talking about, or whatever. I would be down with another year and a blow off top. This could be like 99. If we could squeeze another year out of this thing, we've already had a 2-year bull market, raging bull market. If we could squeeze it to 3 years, he's talking 6,600, but if they could put on 20% this year, I mean, another one, another 20%. I'm not saying, but if a blow off top happens first, if what he's saying happens first, and what he's saying is that he's saying if the Fed's accommodative, well, I bet the Fed will be accommodative. I bet they're going to be getting their arm twisted pretty hard. Everyone else from Zuckerberg to everyone, Bezos, has been super accommodative of the incoming administration. So I'd imagine the Fed will do anything they need to make Trump look good. Trump is ultra aware, in my opinion, of where the market is. He's conscious of it. He knows that it reflects well on his legacy if he has a great market, during his time in office. He always tweets about it. So I would expect him to do whatever he can. If he's able to, I would expect him to try to keep this thing going another year. So I really think maybe Jim's being maybe a little too negative, but you know, he he's a sharp dude. So in any event, let me know what you guys think. All right, guys. I appreciate each and every one of you. You have a great Saturday. All right. See ya.